Hey everyone, and welcome. Let's step right into the consultant's office today. So if you've been crunching the numbers lately, you're probably already well aware of the SIP illusion. You know, that trap where traditional mutual funds just quietly siphon off your wealth with hidden fees while you're not looking? Yeah, we're not doing that anymore. In today's Wealth Management Explainer, we're going to audit that outdated playbook and literally tear it up. Putting on my consultant hat here, I'm going to show you exactly how to escape those massive fees. We are rebuilding your portfolio from the ground up using advanced but highly disciplined tactics with exchange-traded funds, or ETFs. We're talking calculated, systematic growth here, zero guesswork.
Okay, let's take a quick look at the agenda for our masterclass today. We'll kick things off with escaping high-fee funds, then move into building the core ETF portfolio, followed by executing the modified SIP. After that, we'll unlock the power of pledging, and finally, we'll wrap it all up with your wealth-building checklist.
All right, Section 1, Escaping High-Fee Funds. Let's audit that wealth drain.
Let's look at the numbers side by side because it's pretty eye-opening. Traditional mutual funds, they hit you with heavy expense ratios, sometimes draining up to 2.5% right off the top. And if you want out, bam, exit load penalties trapping your money to the tune of 1 to 4%. Passive ETFs, on the other hand, let you trade live on the stock exchange. We're talking expense ratios as insanely low as 0.05% and absolutely zero exit loads. And if you're wondering how to actually make this structural shift, it's super simple. All a beginner needs to do is open a standard online brokerage account. It seriously takes just a few minutes, and boom, you have direct access to buy these low-cost ETFs all by yourself.
Moving right along to Section 2, the core ETF portfolio. These are your 3 pillars of stability and growth. Okay, so here is the foundation of your financial fortress. First up, for aggressive tech growth, you're gonna want a Nasdaq 100 ETF. This is a brilliant move because it instantly gives you diversified ownership in the world's biggest tech giants. Think Apple, Microsoft, and Tesla, all in one go. Pillar number 2 is broad market stability. You need an index that tracks the top companies in the broader market, so something like a Nifty 50 or an S&P 500 ETF. And finally, the third pillar, your safe haven. Look, when the stock market gets inevitably rocky, you absolutely need a secure place to park your cash. This is exactly where you utilize gold ETFs, which directly track the price of gold, or debt ETFs, like liquid Bs. These let you earn safe returns without taking on that stressful stock market risk.
All right, Section 3, Executing the Modified SIP. We are buying the dip with absolute mathematical certainty.
Now, this perfectly illustrates the difference between amateur investing and our highly calculated approach. Amateurs just blindly throw their money in on the first of the month, right? They don't even look at what the market is doing. But our modified strategy? We buy the daily dip. By doing this, you mathematically lower your average cost over time. You are literally creating extra alpha just by being smart about when you click that buy button. Now, you might be thinking, do I need a massive amount of initial capital to start doing this? Not at all. The math here is the crucial part. Let's look at a hypothetical example. Say your goal is to invest $1,000 a month. Well, there are roughly 20 trading days in any given month. Divide 1,000 by 20, and you've got exactly $50 to invest per trading day. $50. That is an incredibly approachable daily amount that serves as your daily ammunition in the market.
Okay, grab a pen because here is your daily execution plan. Feel free to pause the explainer right here if you want to write this down. Step 1. Instead of just setting up an automatic mindless monthly transfer, set a daily alarm on your phone for exactly 15 minutes before the market closes. Step 2. Open your brokerage app and look at the market charts. Are they red? Step 3. Here is the golden rule. You only buy your ETFs on days the market is negative. If the market is positive, if it's a green day, you do absolutely nothing. You just save that $50 in cash.
Let's actually walk through how this hypothetical strategy plays out in the real world. Imagine the market is green for 3 days straight. You stay fiercely disciplined. You save your $50 each day, meaning you're now holding $150 in cash. Then, when the market inevitably crashes on day 4, the volatility kicks in and the amateurs start to panic. But not you. You stay completely objective. You see that red chart for what it truly is, a calculated buying opportunity. You invest that accumulated $200 all at once, right there at the discounted price. That is exactly how you stay disciplined and win when fear takes over the market. Let's jump into Section 4, the power of pledging. This is all about leveraging your portfolio safely.
So pledging is this incredible wealth hack that a lot of investors actually never utilize, but it is absolutely vital for maximizing your capital. Basically, pledging means taking those long-term ETF holdings you just built up and using them as collateral with your broker. In exchange, your broker gives you margin buying power. The absolute beauty of this setup is that you get extra capital to trade with, and you never even have to sell your long-term investments. They stay right where they are, just continuing to compound in the background. When you pledge your ETFs, brokers will often give you margin up to 90% of your portfolio's value, applying what they call a 10% haircut. To put that into perspective, $10,000 in ETFs unlocks $9,000 in pure buying power. But as your professional consultant, I have to give you a very serious warning here. Margin trading carries significant risk. If the market takes a sharp nosedive and your collateral loses value, your broker can hit you with a margin call. That means they force you to either deposit more cash immediately or they'll literally liquidate your assets. Because of that risk, this buying power must only be used for extremely safe hedge trades. Never ever use it for wild speculation.
But when you do deploy those safe hedge trades using your margin, you can aim to legally squeeze out an extra 1 to 3% yield every single month. It's like you're building a dual-engine portfolio. Your core ETFs are compounding away for the long term, and your pledged margin is generating active monthly cash flow right on top of it. It's a real game changer.
Bringing us to Section 5, the Wealth Building Checklist, your disciplined execution plan.
Let's summarize the whole strategy into a quick reference guide so you can execute daily and monthly. Number 1, audit your setup and ditch those high-fee mutual funds for zero exit load passive ETFs. Number 2, build out that 3-pillar core portfolio. Remember, aggressive tech, broad market stability, and a safe haven. 3, set that daily 15-minute pre-close alarm. 4, maintain your discipline. Execute the modified SIP only on red days and aggressively accumulate your cash during the green streaks. And finally, number 5, once your portfolio is big enough, pledge those ETF assets to unlock that 90% margin for safe hedge trading.
So I'm going to leave you with this final thought. You've got the playbook now. We've gone through the math. It's clear. The daily routine is set. So what's it going to be? Will you stick to the traditional SIP illusion and just let those hidden fees quietly drain away your potential? Or are you going to embrace the discipline, execute the modified SIP, buy the dip, pledge your assets, and truly take back your wealth? The choice, and more importantly, the execution, is totally in your hands now. Thanks so much for hanging out with me for this explainer. I seriously encourage you to pull out your phone and set that daily alarm right now. Keep learning, stay incredibly disciplined, and I will see you in the next one.